Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Craig Hemke of TF Metals Report, located at tfmetalsreport.com. And I got to tell you, this sector is hot right now. And if you're in there trading the gold and silver ETFs or the mining companies and you're not subscribed to TF Metals Report, you're doing it wrong. Craig produces great premium content, generally every day, including an article and a podcast, but there's also a ton of free stuff available to the public. So go on over to tfmetalsreport.com, check out what there is to offer. Craig, I'd like to thank you for joining us again on Silver Doctors.
Paul, thank you. It's always a pleasure. Yeah, it's the site's just 50 cents a day. It has always been our mission since we went to a paywall in 2013 just to kind of fight off the trolls and to get away from Google and all that stuff. It's always been the mission not to have it be price prohibitive for anybody. So 50 cents a day. And man, I tell you what, with the year we had last year and again now this year, I think it's proven to be worth it. At least I hope so.
It is indeed worth it. And that's like one Starbucks coffee a week, and they're not even open in half the country. So, I mean, it's totally the best deal on the internet, Craig. Definitely.
Thank you.
Now, Craig, I'm looking at the price of gold, and 1750 was support for the longest time. And then we went up to 18. We were like, oh, we might come down to test it, but I'm feeling pretty good about 1750. Then we ran up to 1900, and everybody started saying, oh, my goodness, we got to pull back to 18. Then we run from 1900 to 2000, and everybody's like, oh my goodness, this thing is just screaming overbought and over bullish like there's no tomorrow. Craig, what are you looking at in gold? What is your assessment with gold right now?
All right, first of all, Paul, I'm reminded that I can barely even follow your question because I think you sound so much like Patrick Mahomes. You don't look like Patrick Mahomes, and you don't have his cash, but it cracks me up every time we talk because I live outside Kansas City, so I see, in fact, Patrick Mahomes belongs to my golf club. I've never run into him there, but he and Travis Kelce are legend for showing up out there and hitting it a mile. But anyway, I digress. Look, the key driver to all of this began in November of 2018. In the period from 14 to 18, the Fed was trying to spin these plates and yarns about how they were going to be normalizing interest rates, normalizing their balance sheet, and I mean, anybody with a brain knew that wasn't going to happen. The politicians always say, well, we can pay off the debt someday. Come on. You got to be a complete buffoon who doesn't understand anything to think that's the case. The debt is the debt will never, can never be paid off because of how horribly deflationary it would be. Okay. Just not, that just doesn't work that way. So anyway, the Fed makes this lie for 5 years, trying to tell everybody that everything's great. And over the course of the 5 years, they trimmed their balance sheet by about $700 billion. And they raised interest rates consecutively every quarter to the point where the 10-year note got to like 3.25%. And then in November 2018, it all blew up on them. That was as far as they could go. You might remember the stock market crashed in December of that year, only to reverse when Mnuchin and the rest had a secret special meeting of the plunge protection team on Christmas Eve that year. And magically then the market went 1,000 points higher the day after Christmas. Yeah. And it was at that point the Fed changed course. And then, of course, we got into the repo crisis of last year. And at that point, the whole $700 billion that the Fed had worked off was immediately put back on. And now here we are this year. I mean, this is, unprecedented, calamitous times that even though our forecast for last year was terrific and that we recognized what was happening with the Fed and with the money supply. And so I knew gold was finally going to break out above 1350. We had a target of 1520 and that's where it went. And then this year I had a target of 1800, not knowing what COVID was going to do, but for the same reasons. And now here we are. I mean, God, Paul, just yesterday, the Treasury came out and said that in the second half of this year, this calendar year, not fiscal year, but this calendar year, they're going to borrow up to $2 trillion. Well, even the word borrow doesn't mean anything because they're not borrowing jack. They're going to get $2 trillion freshly created by the Fed. Okay, so this stuff is rapidly spinning out of control and reaching, I don't know, maybe not reaching an end game yet because they'll continue to print until finally confidence just totally collapses. But in the meantime, we're heading into a period of significant stagflation. The Fed is promising that they're going to institute a couple of major policy changes, it seems, as soon as next month, where they're going to let inflation run hot above 2%, while at the same time keeping interest rates abnormally low through yield curve control. This is going to send real rates, inflation-adjusted rates, even deeper into record negative territory. These negative rates are what's currently driving gold, even here today as we speak. And so it's very important for people not to get shaken off, this raging bull market because of, technical indicators or, oh, look, the dollar's reversing, or a whole bunch of little tertiary items. The key item is this negative real interest rate structure like we had back in the 1970s. And that's the thing that people need to keep an eye on.
Mm-hmm. Very interesting with the Fed's pivot there. A lot of people say 2019, but I find it interesting how you're bringing it back to 2018 as a matter of fact. So
yeah,
the
policy change wasn't announced till June of 19, and so that's when people say, "Oh, that's what." No, really though, it changed in November 2018. That's when everything changed. So anyway, I'm sorry, I didn't mean to interrupt you.
So now, so everybody accepts that the Fed has pivoted, but now the next thing is what you have spoken about called yield curve control. So could you just explain that just a little bit more? Like, what is yield curve control and why should stackers pay attention to it?
All right, this is extremely important. A lot of folks listening to us are probably familiar with the London gold pool. I know you are, Paul. And that was a historical known incidents of price manipulation, okay, back in 1961 to 68, where the U.S. and 7 other countries pledged physical gold to manage the price of gold at the $35 an ounce Bretton Woods peg, okay? So how do they do that? Okay, so you're pegged at $35. How do you do that? Well, when price through pressure, demand pressure would move up to 37 or 38, the gold pool would spring into action and dump a bunch of gold in the market and force price back down. And then if price fell to 32, the gold pool would spring into action, buy that gold back and move it back up to 35. Okay, I mean, that's pretty simple how that works. Same thing with yield curve control. When this is finally announced, I think it's been de facto in place since April the 1st, about when QE to infinity started in late March. But once this is finally announced, what will basically happen is maybe the trading desk of the Federal Reserve Bank in New York will just simply sell bond futures if yields fall too low, and they'll buy bond futures if rates move too high. And you can actually see this. There was a week back in late May, early June, where the 10-year spiked to 1%, like 0.997. In the very next week, bang, falls right back down to 75. And now here we are at like 53. Okay, so you could say we've been in a band, 60 to 75 basis points and now falling out of it since April the 1st. So this is already there. What's going to happen? And hey, look, I'd encourage everybody, just pull up like a 1-month chart of gold and silver. This move, where we're currently on like a rocket ride upward, began on Friday, July the 17th. Also on Friday, July the 17th at about 5 o'clock in the morning, a story shows up on Bloomberg. Not like, some little puny little blog like mine, written and posted on Bloomberg, where Fed trial balloons are floated. This story at 5 o'clock in the morning on July the 17th hinted that the Fed was soon going to be implementing a major policy change. I don't know, Paul, maybe I'll send you the link. You can put it with this, or anybody can go to Google and find it. What this was and what they said is coming is a two-pronged strategy of letting inflation overheat, as they call it, because Powell thinks they acted too soon to start raising rates back in 2012 and 13. And so part of that dual mandate they always talk about is 2% inflation, right, and full employment, whatever. That this time the Fed's going to let inflation overshoot 2%. Now, that's going to come, this article said, with this policy of yield curve control, where the Fed will, say, look, we're not going to let the 10-year Treasury note go above 75 beta. Let's just call it 1%, just to keep the math simple. Okay. Again, they'll step in, start selling bonds if it goes below 50 basis points and buying bonds if it goes above 1%, just to keep it in that band. Okay. Now, normally, 20 years ago, if inflation went to 2 or 3%, then interest rates would go up as well. Okay? And your real interest rate, the inflation rate minus the stated rate minus the inflation rate, your real rate would stay in like a plus or minus 1%. Okay? But when the Fed institutes yield curve control, keeping rates at say 1%, and then inflation goes to 3. Great interview I saw this week with Russell Napier, said it could go to 4 in the short term. Well, now we're talking, again, a 1% nominal rate minus a 3% inflation rate is a negative 2% real rate. Right now, as we speak, gold's going crazy because real rates in the U.S. are making new all-time lows at 1.05%. What happens when it goes to 2? What happens when it goes to 3? And again, the fundamental part of this, Paul, is that the key competition, if you will, for institutions and central banks and hedge funds and pension funds and the like, the key competition for gold, holding gold, is a U.S. 10-year Treasury. It's the bedrock foundation investment for all these things, for all those institutions. Well, if you're guaranteeing these institutions a negative return in terms of purchasing power over the next 10 years, well, hell's bells, gold that just sits there and collects dust as a pet rock and appreciates in value is pretty damn good competition as a tier 1 asset. And that's why gold's going to continue to rise. Again, the Fed has indicated that this is coming. That's what that trial balloon was all about. It is not a surprise. It is a direct correlation that article hit on July the 17th on Bloomberg. And anybody astute and paying attention has been buying gold ever since. And gold's gone from 1780 to 1980, 2000.
Very interesting. So I'm understanding this right. So if the Fed's going to target 1%, and if inflation's running at 3%, that's like a negative 2% real yield.
Yeah.
So I'm thinking, well, people who have really deep pockets who would either hide out in bonds or in gold or whatever, it usually costs about 1 to 2% just to store gold. So just right then, you're at least breaking even or even winning out in that, because the gold is just collecting dust, but you're still losing less with that 1% than what the negative real rate would be.
Right.
That's point number 1. And then point number 2 is, and then on top of that, if a person believes that the markets have been rigged, and that's what inflation yield control curve is just market rigging in its purest sense. So if a person believes that the precious metals have been suppressed in price, then there's also massive capital appreciation that can be coming as well.
Right.
Am I understanding yield curve control correctly there, Craig, or anything you would want to say to add on to that?
No, you nailed it. Again, for most wealthy people that have metal in size, their storage costs are maybe 0.5% a year, if that. Okay, so if that's the only cost to owning gold, and you got the capital appreciation because everybody knows that fiat's being devalued. I mean, there's no turning back on that. The economy's not going to immediately recover in the next 3 or 4 years. Then all of a sudden, gold's a very attractive investment, especially at that tier 1 level. For the banks and central banks and big institutions and pension funds and insurance companies and the like. So then, as you said, then all of a sudden, if the banks are forced to deleverage this pricing scheme that they've concocted over the last 40 years, holy cow, we might really be onto something. And that's coming at a rather interesting time, because you and I, the last time we spoke, we discussed this. The banks were so abusing the pricing scheme by the time we got into the first quarter of this year, that things were getting stretched and out of whack. And when the market broke on March 23rd, everything changed. And now you've got bullion banks getting out of the business. They clearly don't trust each other from a counterparty standpoint. In fact, what was again, when we spoke about this, I've written about this for the last couple of years. There's an arcane process in the COMEX called the exchange for physical, where you could take your COMEX contract that's worth 100 ounces and exchange it for physical off exchange, typically in London. Okay, hardly ever used to get used. And then suddenly, beginning in about 2016, use of it skyrocketed as a way to kind of arbitrage between the futures price and the spot price, and as a manipulation tool. In fact, in the first quarter of this year, Paul, There were 290,000 COMEX contracts that were exchanged for physical in just the first quarter. Okay. That's 900 metric tons of gold, allegedly. Okay. The peak craziness was on March the 12th when 38,000 contracts were moved that way. Okay. Whole thing blew up March 23rd. EFP abuse absolutely cratered, and it has stayed that way. Again, this is a sign that the banks don't trust each other to either deliver medical, if you're going to sell the futures contract and buy the spot to close the spread, you've got to deliver on your sold futures at some point. Well, you don't have any gold until somebody delivers it to you that you bought at spot. Okay. And the fact that the banks aren't doing this anymore tells you they don't trust that the gold can be delivered, to the extent where just yesterday, we're recording this on August the 4th. Yesterday, August the 3rd, I gave you this number for March the 12th of 38,000 EFPs. Mm-hmm. Yesterday, it was something like 688.
Wow.
So again, there's some real structural issues in the pricing scheme.
There is.
Throw that log on the fire too.
There is. So let's stay on this, and let's stay on this banks topic and transition it into silver a little bit, because I know about a month ago, I think you've been talking about JP Morgan might be in a pickle here, Craig. Yeah. And the reason why I say that is because, well, if they keep shorting it, then their stash that they have at the COMEX might just start dwindling down.
Right.
So, it looks like they might be wanting to let it rise here. But then if they let it rise, then that's kind of like stabbing the other banks in the back. So, I mean, it's all a good thing to end the manipulation one way or another. But my question for you is, what are you looking at in silver? How are the shenanigans working out in silver? And how has this been progressing over the last month here?
All right. Well, as maybe most folks know, maybe they don't. For the COMEX derivative futures trading market to have any relevance at all, they have to deliver some metal at the price that's derived through the trading of these phony baloney plastic banana futures contracts, right? So every other month, in gold, it's February, April, June, August, October, and December. In silver, it's March, May, July, September, and December. Every other month, a contract is considered a delivery month, where parties that want to take delivery, and usually it's always just been banks in kind of a circle jerk of swapping positions back and forth to create this illusion of delivery. Mm-hmm. But you can stand for delivery and take delivery and, hold it in a COMEX warehouse. And basically you're getting a promissory note or a warehouse receipt or something like that. It's not really actually gold, but it creates this illusion of delivery. Okay. Mm-hmm. After this whole thing, the scheme just blew up in their faces and counterparty risk surged and confidence evaporated. After that happened on March 23rd and 24th, the CME, in a desperate attempt to, I guess, maintain some integrity or confidence in their COMEX, decided to turn it into a physical delivery vehicle. Ever since, deliveries have just gone through the roof, where you might get in the past 4,000 or 6,000 contracts delivered in a month. We had 32,000 in April and 52,000 in June, and we're on pace to do about that many again here in August. Okay, so now they've got a real problem on their hands. Okay, they've opened Pandora's box. Well, now let me go back to silver for a second, Paul. And I apologize if I'm filibustering here. I'm not intending to, but it's a long story. Silver.
No, it's crucial. So people might want to listen to this interview twice. So.
Yeah. All right. Silver is now having the same problem. Where they used to deliver 2, 3, maybe 4,000 contracts a month, they did 17,000 in July. The next delivery month will be September. Okay. That contract is the current front month. It'll go off the board here in about 3.5 weeks. Okay. And we'll see how many stand for delivery again. But since this is continuing in gold, it'll probably continue in silver as well. Okay. Let's back up. There are people out there that claim that JP Morgan holds like a billion ounces of silver. I have no idea. I think that seems kind of pie in the sky. That they would own all these silver eagles, allegedly, and all these vaults. Well, whatever. Hey, if they do, good for them. All I know is what I've been able to track through the data provided by the CFTC over the last 5 years. And over the last 5 years, I've tracked it every month. The house account of JP Morgan, their proprietary account, would take delivery of silver contracts every single delivery month. 1,000 contracts here, that's 50,000 ounces. Another 1,500 contracts the next month, 800 after that, 2,000 after that. If you go back, and I have all the numbers, if you go back since 2014, you total it all up, it comes to about 150 million ounces. And if you go back to how much silver JP Morgan showed in their vault, which they didn't have in 2011, they only rushed to open it in 2011, went from 0 to about 150 million ounces. Most of it eligible. Well, those dots are pretty easy to connect, right? So back when the July silver went into delivery, the very first day, the house account at JP Morgan had to issue out, for the first time that I'd seen in 5 years, 6,000 contracts. Hey, wait a second. This is different. The very next day, the silver stocks report that the CME puts out showing how much silver is in all these vaults, the gold vaults and the silver vaults and all the depositories. The JP Morgan eligible silver vault declined by 30 million ounces. And they had to move it to registered, meaning it was ready to be delivered. Yeah. Light bulb, right? I've been counting this all along. I've always thought that JP Morgan accumulated all of this silver so that instead of being naked short as they were in 2011, they instead could always just simply say, we're just hedging our 150 million ounces. That's at 5,000 ounces a contract. That's 30,000 contracts. That meant that they could be short every delivery period, every front month, 30,000 contracts. Okay, so price would go up a certain level, they'd short it, go back down, they'd buy it back. Kind of like that gold pool I was talking about. I mean, I'm telling you, they made a boatload of money over the last 5 years because 30,000 contracts give you basically monopolistic control of the price.
And the CFTC turns a blind eye on position.
Well, or the CFTC is just a bunch of worthless bean counters, and JP Morgan just says, hey, look, we got 150 million ounces. We're a bona fide hedger. We're just hedging. We don't take a directional bet like Blythe Master said, when instead what they're doing is monopolistically controlling price and making, as banks like to do, consistent trading earnings, month over month, quarter after quarter, year after year. That's what banks do. Banks don't just look for a big one-time shot. Hey, look at us. We made, $100 billion trading gold. Or, no, they want to make $500 million a quarter. That's how banks operate. And that's what JP Morgan's been doing. Okay, so now, just to kind of answer your question, it looks like they're getting kind of forced out of this business because the CME turned the COMEX into a delivery vehicle. And now JP Morgan gets hung out to dry with 6,000 shorts still open at the 1st of July that they have to deliver against. And so now instead of 150 million ounces that they can hedge against, they've only got 120. Instead of 30,000 contracts that they can hedge with, they can only hedge with 24.
Yeah, and that's not going to last long.
Well, what happens in September? Yeah. If we get another 17, 20,000 contracts standing for delivery, JP Morgan going to puke out another 30 million ounces? Okay, if they do, then they're going to be down to 90. Okay, they're losing their ability to control price. The other option is they stop shorting so they can hold on to their 120 million ounces. And at that point, they've lost their ability to control price. Kind of a win-win deal. And look, silver's moving up because of gold, and gold's moving up because of real interest rates, and silver's moving up with that factor in mind too. But this is a pretty radical change that is apparently taking place, not only within the COMEX, but specifically to JP Morgan's domination of silver. And so this is something people want to keep an eye on.
And it also sounds like that these developments, it seems like every time they're trying to put in these new shenanigans to just keep the game going a little longer, the less impact the shenanigans have, and the more it is that they're overwhelmed. Like the EFPs, it surged and then it crashed, or JP Morgan's built up this stack, and now wait a second, they're going to get to the point where they don't want to give up any more of that stack.
Right.
Very interesting. So which brings us into the world of currencies and debt and just, I'm reading headlines today, and Argentina's blowing up again for the third time in 3 decades, and the Turkish lira is crashing, and just the monetary insanity with all of this monetary inflation even though some people would argue it hasn't converted into consumer price inflation. I would argue that it has, but just with all of the lunacy. And then on top of that, this World Economic Forum, the Great Reset. Do you put any credence or any kind of credit into that? Are you looking at that as something on the horizon next year? Or just what are your thoughts on the current debt situation and the currencies in general, and also the DXY that's now trying to hold 90 here, it looks like?
Yeah. First on that
However you
World
want to take
Economic,
that was a lot there,
that
Craig.
was a lot. I'll try to remind me if I'll probably have to ask you to remind me to make sure I cover all those points. But first, with the World Economic Forum, I don't know. I think that's kind of a coincidence of titling. I don't know. Maybe they know exactly what they're doing, and it's not a coincidence. But if you look through that web page where they, specifically devoted to this, the Great Reset they're talking, it's a multifaceted thing, where they're talking about global warming and all this other nonsense. So I'm not sure that that's specific to, but hey, look, the way this is trending, I mean, with the global economy and the amount of debt that, just is spiraling out of control, and the fiat creation to service that debt, yeah, maybe it'll happen anyway next year. We'll see. I mean, it's basically a function of confidence. The currency system, the floating exchange rate system will only continue as long as people have confidence in it, so we'll see. Okay, Paul. See, I've already forgotten. What was the other part of that?
just the currencies in general, the dollar.
Okay.
I mean, people are still thinking the dollar's going to strengthen, and I see it plummeting on a daily chart. So
let's go back to that for a second, because again, this just drives me bananas, man. I've dedicated over 10 years of my life to just gold and silver. Okay, I can assure you, my friend, and everybody listening to us, these are not just little static dots on a screen where you can apply Elliott wave theory or some simplistic explanation like an inverse relationship with the dollar to it. There is, multiple levels to understanding what moves the gold price, okay, and silver as well. So what drives me crazy are these generalists that come out and say, well, the reason why gold went up today is because the dollar went down, so traders everywhere were liquidating. Come on, man. A rising dollar can be a headwind on a daily basis. A falling dollar can be a tailwind. But even as we speak today, Paul, spot gold is challenging $2,000 an ounce, up like $20 or $25, and the dollar's up too. So what would the generalists say about that? Or let's go this way. The dollar index has been crashing down to about 93. You know when the last time it was 93? June of 2018. You know where gold was in June of 2018? About $1,300. So why is it, if it's just the inverse of the dollar, then why isn't gold $1,300 now? And this just drives me crazy. These simpletons that offer that as some kind of sophomoric explanation of why gold's moving. Yeah, the dollar is going down, but that's only relative to the currencies that make up that basket, the dollar index. So it's the whole cleanest shirt in the laundry, tallest, well, that's politically incorrect to say tallest midget, but you know what I'm saying. Okay. So this idea that somehow gold moves as the dollar moves relative to other fiat, nonsense. The only thing I will say is that I've been repeating since last year at about this time, when gold price started to make all these new all-time highs versus other currencies. I remember reading something once where Bill Murphy counted up like 73 of them or something like that. And gold was at all-time highs in the pound and the yen and the euro and even in SDR. Okay. Well, it became real obvious. I mean, I stated this repeatedly last year. Well, it's just a matter of time before gold makes all-time highs in dollar terms then. I mean, it'll be the dollar's turn of the barrel. It's currently the dollar's turn of the barrel, and here we are. But it's not driven by it just drives me crazy when people say that, because there's so much more complicated than that. And real interest rates are the key driver. I cannot stress that enough.
Mm-hmm. Now, Craig, transitioning here, as we wind down, I generally like to ask people what's on the radar the most. I just kind of want to tell you what's on my radar and something that I don't really know about. So I don't know if this is on your radar the most, if not. But, last year we kept reporting a lot about problems with natural disasters affecting the food supply. And it was global. You know, we were talking about flooding here. We were talking about Arctic blasts here. There were these locust plagues. There was a swine flu. There were all these things affecting the global food supply. Then we enter in 2020, and now we have to add in all these supply chain disruptions on top of that. You know, I mean, the last order I put in at Walmart, you know, where that little car comes to my house and delivers my groceries now, it's so amazing. You just click, and then all of a sudden you got freshly baked French bread. Well, they couldn't bring me crackers. They couldn't bring me pasta. They couldn't bring me ham, right? So it's like, there's some concerns that I have still with food and food price inflation. It was food price inflation, but now it's like, is it the actual food supply that should be a concern and not just the inflation? Now, on top of that, here in the middle of 2020, I'm hearing something about this Three Gorges Dam in China and that it might have the ability to adversely affect the food supply. Now, I don't know what the Three Gorges Dam is, but I guess I should know about this. So, Craig, please inform me what is going on with this. And this is something that should be on my radar there.
All right. Yeah, I've got to track it too, man. If you're a gold bug, you pretty much got to pay attention to everything. You know, you got to get to the bottom of what's going on with COVID, what's really happening, right? You got to watch out for natural disasters. And man, let's just start there because, I mean, it's kind of a joke in a sense to say the hell else can go wrong in 2020, right?
Yeah.
I mean, maybe the next thing that's going to happen is the North Koreans and the South Koreans will finally get it. I mean, why the hell not? Everything else is happening this year. Yeah. How about a nice natural disaster? You know, how about an 8.5 on the San Andreas Fault or something? I mean, all these things you think, you know, what's going to happen next? All right, well, that is a pending natural disaster. Anybody can Google Three Gorges Dam. It was built started about 20 years ago. You may remember from your geography classes as a kid, the Yangtze River in this kind of almost fertile crescent of China, you know, and all the people live along the Yangtze River. But it would flood every year, right? It's like a lot of rivers do. And as people build stuff along the river, you got to control the floodplain. So they built this thing called the Three Gorges Dam, which at the time, and it may even still be, the largest hydroelectric, you know, man-made dam in the world, right? All right, Paul, you know, all that stuff you pick up from Walmart, right? The rubber dog shit they fly out, you know. How high quality is that stuff usually?
Garbage, low quality stuff.
Okay, that's the concern, man. How high quality is that dam? Now, here's the problem. They told us when they told the world when they built it, it was built to sustain a 10,000-year flood. Then they said, well, maybe 100.
Oh, no. I don't like where this is going.
Well, the problem is, man, they're in the midst of at least a 100-year flood. In that above the dam in the floodplain up there, it's just pouring rain every day. In fact, I saw something last weekend that they were supposed to get maybe upwards of 10 inches of rain by the middle of I guess it's 2 weeks ago, by the middle of last week. Well, that doesn't immediately flow into that reservoir behind the dam. It takes a while, right? Rivers eventually rise and then it floods. And the problem they're having is the inflow into that reservoir behind the dam exceeds that they can let out. I mean, you can only let out so much, right? Through the floodgates. So if the dam, let's just pray it holds. Let's just put it that way. Okay. Because if it fails, there's something like 400 million people living downstream. I've read there's as many as 60 nuclear power plants. How would you like to have 60 little Fukushimas on your hands?
Yeah.
So yeah, that's, as an aside, that's something people should be aware of. What am I really watching? Let's go back to that article from Bloomberg from July the 17th. People have been wondering when the Fed would institute yield curve control. The Fed itself admitted at the June FOMC that they'd gotten presentations on it because the U.S. has done this in the past from 42 to 51 as a way to inflate away the massive debt that was accumulated during World War II. They put in yield curve control, let inflation run. You know, that was when they, you know, we always hear these things about this is the worst debt to GDP ratio since World War II. Well, that's part of how they managed it. They inflated it away. And one of the tools they used was yield curve control. And the Fed admitted in June after their FOMC, this is now 2 months ago, that they'd received studies, a presentation on it. And you can read, there's research papers out there from the San Francisco Fed and the St. Louis Fed about, you know, the efficacy of how successful that could be to use it now. So the Fed's admitting they're looking at it. A lot of folks have been saying that they're going to admit this in September, the September FOMC. Now, we just had an FOMC last week, and a lot of people were thinking, well, maybe they're going to announce it here at the end of July. Man, they're not going to announce it at the end of July. I mean, that's a seminal change in policy. They're not going to announce it when everybody in the world's getting ready to go on vacation. Okay? However, so long answer to your question, the next FOMC is in early September. Keep an eye on that one. That's what I'm watching.
And what is the one thing the most that you want people to get out of TF Metals Report? And I already know your answer. Should I spoil it for you?
Yeah, go ahead.
Community. Yeah. That's your answer, because you don't have the trolls like we do over at Silver Doctors. So tell us a little bit about what people can get out of tfmetalsreport.com.
That's the thing about which I'm most proud. We've always had kind of let me put this. What I hate about the internet and I hate about Twitter is, these people that argue all the time. You'd say stuff on Twitter you would never say to somebody's face, right? Ever in a million years. Or the comment section at Zero Hedge. Okay, maybe it's good that you can vent that way, but my God, what are we doing to civil society by promoting, to say these horrible things to people? So we've always had at TF Metals Report the golden rule, which is, treat others the way you want to be treated. And so it's promoted a great community. I mean, we've got people from around the world. Never had more subscribers. I mean, business is great. But everybody's from around the world, different political stripes, different backgrounds, but we're all in the same boat. And so we treat, economically, it doesn't matter if you're a Democrat or a socialist from Europe or whatever. We're all stuck in the same boat at this point with kind of a mutually assured economic destruction. So the community kind of binds together, helps each other out, adds all sorts of information to each of my threads that I do, a couple a day. And that's what really adds value. And again, geez, 50 cents a day. For crying out loud. If you've been following along every day, I think we're making that back for you.
Yeah, I would agree too. Craig Hemke, I'd like to thank you for joining us again on Silver Doctors.
Paul, it's always a pleasure. Let's keep in touch.